Financial modeling is the #1 difference between scaling a competitive business and crashing and burning. Your agency is probably not going to fail because you magically forgot how to get clients. It's going to fail when you run out of money for reasons you had no idea existed in the first place. So in this video, I'm going to show you exactly how to track, forecast, and control your money so you are never blindsided again. We're going to go over all the tools, benchmarks, and strategies that you need to stop guessing and start operating a wildly profitable service business. If you guys want more clients, more sales, and marketing that actually works, you should subscribe because that's what all my videos are built to help you do. Naturally, the first thing we need to talk about is why financial management matters in the first place. So understanding your business's cash flow is absolutely necessary to make informed decisions that impact your bottom line revenue. So your pricing structures, your managing margins, analyzing what services are the most profitable and which clients are the most profitable, just maximizing the return on investment for team training, new software, certifications, whatever it might be. Now, good financial management is going to allow you to know when you should invest in growth and where you should focus new development in your company for the maximum return. So for example, let's say you need to hire a new project manager, but your forecast tells you that you have a seasonal revenue dip every single Q3, right? So you're obviously not going to hire during Q3 because that would cause a major cash strain. So you wait until Q4. You avoid that major cash strain and you ensure that the investment into your team happens at the most profitable time. Okay, now that you understand that, we can start talking about bookkeeping. So bookkeeping is not just a tax compliance thing, right? It's a decision-making tool. Most business owners are in the wrong financial mindset for the stage of their company. So early on, they're over-optimizing their finances and they're slowing their growth. And later on, they're under-optimizing and they get blindsided. So you can't optimize what you're not tracking. So even if you're a new business, you should start tracking all of your purchases, investments, and whatnot with something like QuickBooks, Xero, or Sage. All your transactions should be categorized. If you don't have this, you're going to start commingling finances, you're going to lose clarity for your taxes for the following year, and you're just going to make decisions based on vibes and not data, right? So every single time that you scale your company to a new, let's call it an arbitrary milestone, your approach is going to change pretty dramatically, right? So let's say around $0 to $10,000 a month, you're mostly focused on generating cash flow, right? Taxes are not really a big issue for you yet, but you should start tracking everything, like I said, from day one. You want to set up your accounting software, connect all your business bank accounts and categorize your transactions versus the company. Now, when you hit around $10,000 to $50,000 a month, you can start hiring accountants, right? Taxes are going to become a major expense here. They're going to, be more than you expected them to be, and they blindside a lot of new business owners. A bookkeeper that is good is probably going to cost you anywhere between $300 to $2,000 a month. And at this stage, cash forecasting, which we're going to talk about in the section after this, is going to become your #1 priority. Now, at around $50,000 to $100,000 a month, the business is going to start outgrowing you, the founder. You might have a couple freelancers or employees. You just need to make sure that your accountant can handle payroll. You can start really dialing in on reporting for all the performance metrics, KPIs, profitability, all those things. Now at $100,000 to a couple $1 million a month, now you are absolutely in fractional CFO territory. And as the founder, you should become the visionary for the company and you should be supported by a finance team. So now cash modeling, pricing optimization, mergers and acquisitions, if you plan on selling, and raising money are all going to come into play. And after a couple $1 million a month, you're likely going to need a full-time CFO. Now we can start talking about cash forecasting. So all cash forecasting is telling you how much money you're going to have in the future so you can make better growth decisions right now. Now this document is going to be available in the description of this video for free. I don't need your email or anything like that. So you can copy this table to your business. Now, long story short, we just need 4 main sections with comparisons month over month, and obviously a starting balance, compared to an ending balance, right? So we need to have a section for our inflows, our outflows, debt and taxes, and then owner withdrawals and investments. Now, when you're reviewing this, we want to look at a couple of very important things. So trends in inflows and outflows, of course, month over month cash position changes. What are the major areas of income for the company? What are the major areas of spending? When throughout the year are you in surplus? and then what potential changes could happen to your top line revenue based on new service lines you might implement, new products you're selling, changes to your contracts, etc. Where is a lot of money in your company being wasted with no return, and where can you reinvest any excess cash that you might have? Okay, great. Now we can start talking about some nerd metrics. I'm just kidding, but I think a lot of companies do believe that financial health benchmarks are kind of nerd metrics and they don't pay a lot of attention to them, but we need to reframe them as early warning signs for when your company is about to feel a lot of stress. So first, we need to make sure that our current ratio is above 1. All this means is, can we pay our bills this month without scrambling? So if this is under 1, what this usually means is that you're relying on future invoices or potential clients to cover the expenses that you've already incurred, which is how all businesses end up reactive, and you start underpricing all of your stuff to scramble and get that money, right? Secondly, we want our net profit margin to be above 10%. All this means is what's left after everything is paid, right? Now, revenue, of course, doesn't matter if you have nothing left at the end of the month, and sub 10% typically means that you're one bad client or one delayed payment away from a lot of trouble. Now, third, we want to make sure our operating expense ratio is below 60%. This just tells you whether the next move for your business should be more clients or more customers, or better pricing or better systems. Now, ideally, in a perfect world, your revenue should go up, then your expenses should go up. And if the reverse is happening, then you are scaling backwards and you need to totally reevaluate what is happening. Now, fourth, we need to take a look at our interest coverage ratio. If you do happen to have debt, this should be above 2. This just means, can your profits comfortably cover any debt that you might have? If this is tight, then debt is going to stop being leverage for you, and it's just going to control all the decisions you make. And like we talked about before, you're going to start scrambling to get new clients and get money as fast as possible. And lastly, we just want to make sure our burn rate / runway is at least 3 months in advance. This is just simply how long could you survive if all sales stopped tomorrow. This is, again, same as before, the difference between making logical decisions and panic discounting everything. Now, some really simple red flags to watch out for are, again, commingling your finances, not reviewing your expenses very regularly, not having any plan to manage existing debt, no periodic budgeting or forecasting, forgetting to budget for one-off expenses like team training, personal training, certifications, whatever it might be, and just not having a long-term financial plan for your business. All right, now this is going to be the most complicated section, but I would argue that it is the most important. So we're going to talk about finding inefficiencies inside of your company using financial modeling. So there are 3 layers of any business's finances. And if you don't understand the way that these relate to each other, there is no way you could ever find the root cause of a problem inside of the business, right? So the 3 layers are, number 1, your financials, which show how you're doing overall, but not what you have to fix. The metrics, and these are the direct drivers of your financials. So, your cost to acquire a customer, your lifetime value of said customers, your return on ad spend, etc. And then KPIs, which are associated with your metrics. So the indirect drivers that improve your financials long-term. So your sales conversion rates, customer satisfaction scores, etc. Now, if we take a look at a top-down view of, let's say, an agency, right? We have our company and then the metrics associated with the company. So your overall revenue, your overall margin, your overall operating margin, whatever it might be. And then you have particular divisions inside of your company, right? And every division has different services and products that you offer to the customer. Now, from there, every single thing that you're offering to the customer has metrics associated with it. So for my services and for the courses and coaching that I offer, those have revenue and marketing associated with them, and every single one of the courses and services individually that I'm selling all have signups, cost to acquire a customer, lifetime value of said customer, return on ad spend for all of the marketing, and even further down, all of those metrics have different KPIs associated with them. So clicks and views, client satisfaction, contract length, sales conversion rate, booked calls, etc. Now, I bet I can make this easier to understand by relating it to a sports game. So think of your financials like the scoreboard, right? So that's going to show how much money you've earned and kept after all the costs associated with running the business, right? So your revenue, gross margin, operating margin, net profit margin, all of those. Now, your metrics are the stats of the players on your team. So that's going to explain, if you're winning or losing. In the business world, what's causing your financials to be good or bad. So your cost to acquire a customer, the lifetime value of that customer, your return on ad spend from all your different marketing sources, etc. Now, improving your metrics is usually going to improve your financials. So think of it like if you have a team with better stats, you're probably going to win and score higher, right? Now, your KPIs are the plays your team is running and the things that they're doing in the off season, let's say. So these are the specific actions or measures that you're tracking within your business or your team that influence your metrics, right? So your sales calls booked, your sales conversion rate, your customer satisfaction score. And in the sports world, that would be, is your team watching film? Are they eating right? Are they training in the off season, etc. Now, your KPIs are your leading indicators. So they're going to show early signs of what will probably happen in the future. So if your team is not eating well, they're not training, they're not going to have very good stats, and you're not going to win a lot of games, right? Now, I'm going to give you one really solid example of reviewing an issue within a business so you can copy this in your business, right? So let's say I'm looking at my agency, right? And from the top down, I see that my operating margins have dropped. Now, I could chalk this up to being just a sales issue, but you'll see how that is definitely not the case most of the time, right? Now, to properly check this, I'm going to first look at my metrics. I'm going to go one level down. And let's say I see that my cost to acquire a customer has gone up dramatically. Then after that, I check my KPIs and I see that my sales conversion is down. Now, I want to check everything that's associated with those metrics and those KPIs, right? Now, I see within my services that nothing is under or overpriced compared to the rest of the market. I don't see any problem clients, and I don't have any issues with my contractor hours. But I start reviewing my sales calls, and I find that my reps are having a lot of trouble explaining a new service that we just started offering. So I find out that the solution to my lower operating margins was to launch new sales training, right? And like I said, at a high level, it looks like every problem in your company is just a sales problem, right? But at a granular level, finances will always show you the true problem inside of your business, right? If you don't understand these base financial principles, you can never isolate inefficiencies in your business, so you will always fix the wrong things. And lastly here, we can talk about some quick wins and investment options. Now, especially if you're a service provider and we're doing, $1,000 plus engagements with all of our clients, you should probably be using ACH. All this means is withdrawing directly from your client's bank account. And if you offer, some adjacent services or you're in a different industry, just make sure you're experimenting with different payment processors until you get the best rate for whatever it is that you sell. Now, in order to do this properly, you must have an auto bill clause in your contracts. So something to the token of by signing, you are agreeing to ACH bill at time of work delivery. Obviously, check with a lawyer for proper verbiage here. Now, third, we want to make sure that we're using our credit card points strategically because we're going to be racking up, thousands of dollars for software and whatnot. There's a lot of different avenues you can use your points for. And lastly, we want to make sure that we're choosing the right entity structure for whatever stage that our business is at. So for example, a lot of companies start off as an LLC because it's really simple, but you will probably switch to an S Corp once your owner compensation and profits reaches somewhere beyond $40,000 to $70,000 a year. I'm in the Northeast, it was closer to $70,000. Basically where your profits are high enough to benefit from the savings you will get from the self-employment tax. Obviously, again, confirm this with a professional based on your unique scenario. Now, for investment options, these greatly depend on your lifestyle goals and your tolerance for risk. So firstly, we want to invest in you, the founder of the company and your brand. So, personal brand coaching, further development of your skills as a leader, different seminars and whatnot. Then we reinvest into the business, different technology, better tools, better software, streamlining our ops, enhancing productivity, giving yourself the competitive edge that you need to succeed in your market. And then after that, talent acquisition and development. So, recruiting and retaining top talent, offer them competitive salaries, benefits, and, professional development opportunities. And then marketing and branding, of course, increasing your efforts to build a strong brand presence, not just for you, but for your company, expanding your company's reach, and then attracting higher quality clients. And then thirdly, something I don't see a lot of business owners do, acquiring equity in other businesses. So you can share clients among businesses in your niche and in-house software as well. And you can work with agencies that offer complementary services to whatever it is that you offer. And then, the obvious, real estate and the stock market. Again, consult experts for those. Now, long story short, tracking the right data and forecasting your cash is how you build a predictable and profitable business. Now, if you guys found this video helpful, make sure you like, subscribe, and drop a comment below on what topic you think I should cover next.